So here we go. We're here to talk about shipping in the capital markets. My name is Dan Rodgers. I'm a partner with Watson, Farley, and Williams here in New York. And we have a distinguished panel of speakers today. We have Christa Volpicelli, who's a managing director with Citigroup's Global Transport Group. We have Rikard Vabo, who is with a head of corporate finance at Fearnley Securities. We have in the corner there Chris Weyers. He's a head of Maritime investment at Stifel. We have Todds Wilson from Jefferies, and we have Schless from Wells Fargo, who's also an MD there. The capital markets have been a very interesting place for shipping over the years, and the last 2 years it's been relatively quiet. So I think, right now we want to start with an obvious question. Let's talk about the U.S. capital markets, and do we think they are open for shipping? Would anyone like to take the helm on that one? Anyone want to go first? Rikard, would you like to go with that one?
I'll start. Shipping has been through a rough period. We have seen rates at extremely low levels and negative levels, and share prices as well as investor sentiment not being there for basically the last three years. The IPO activity in the US, if we primarily focus on that market, has been close to zero, more or less, and existing names today are trading at or below net asset values. Existing names being first class names with prime assets, strong management, solid balance sheets, good corporate governance structures, etc., etc. But right now the sentiment is not there. We're setting new records for tech sectors and other sectors every day. The only records we've been setting the last few years is record lows. But I think that is about to change. We are in a recovery phase in most shipping segments. Banks are holding back, so there will be more activity in the capital markets. I can come back to that a bit later with more details. And I think we are seeing now the yards have finally started moving their prices upwards from 3-4 years of downward pressure on prices. They have become more confident, and that will also put pressure and focus upwards on asset values. Again, order books have come down dramatically, and I believe the market balance within all shipping sectors right now are entering a very interesting phase in terms of rate improvements. And I think we're going to see a very interesting recovery in the shipping market. Just as to put a few words on the size of the market we are speaking here today. If you look at the total shipping market globally, everything from Genco and DHT and Euronav in US to Maersk in Denmark, Mitsui OSK in Japan, we have a global market cap today of $200 billion for the shipping industry. If we do the same for oil service, everything from Schlumberger, Transocean in US to Modec in Japan, and the Norwegian drilling names, etc. We have a $300 billion market cap, combined $500 billion market cap, which is equivalent to less than 2% of New York Stock Exchange and Nasdaq combined. So it's overall microcaps we're talking about, but we're entering a very interesting recovery phase right now. So I think times are changing, and we're going to see a lot more focus on the maritime and energy space the next couple of months and quarters.
Thank you. Christa, what's the view from Citibank, one of the market leaders in this area? Where do you see this whole thing going right now in the U.S.?
Sorry, let me just adjust this a little bit. I would say, so the markets overall are very strong in the U.S. The equity markets are strong, the debt markets are strong, the convertible markets are strong. As Rikard has said, it's a question of shipping and what the performance has been. I think you could make the argument that if you look across all sectors of the publicly traded shipping stocks, the equities are all still at very low levels versus where they were several years ago. And in most segments, we're at a state where the order book is in a much better place than it was in more recent times. And so that sets up an interesting dynamic in our view in terms of investors who want to be coming into the sector at potentially low entry point. Now, for the companies who are already public, if you look across the commodity sectors, tankers, dry bulk, LPG, you have a market where the publicly traded shipping companies are trading at discounts to NAV of anywhere from 60% to 80%, depending on the sector. So if you're in the markets as a shipping company, you're not wanting to be issuing equity to dilute your existing shareholders. So that's one of the key questions, right? It's a good time for investors to be coming in theoretically, but if you look at where the stocks are trading, it's not a great time to be issuing equity. And one of the challenges of the sector is just with the lower liquidity of all of these stocks, it's very hard for investors to establish a position. So in our view, the markets will be there, but it will be for companies who are offering investors the right liquidity in terms of investment, the right size, and the right value opportunity, and how their story is differentiated.
Well, Todd, let me ask you, do you agree with Christa's views?
Yeah, I think she's spot on, right? I mean, the issue with shares in shipping right now is there's no liquidity, right? So even if investors have made that leap to say shipping stocks are undervalued compared to the rest of the market, can they get into a stock that they can get in and out of, right? Can they actually capitalize on a recovery? And will there be a buyer's market out there buying up the shares to recognize that undervalue? And so I think that's part of the problem. And then I think, from a new issue perspective, coming into that, it's been almost 3 years now since there's been a shipping stock IPO in the U.S. And the question is what are you offering that they can't get in the market and that they can't get in the market at a discount? I wish there was a big company that had, multi-billion-dollar asset value that was going to be a multi-billion-dollar market cap company IPO, because I think that's what investors would embrace, but it doesn't exist.
No, I understand. Let me ask Eric, do you think there is something that shipping companies might be able to offer that would make them attractive to investors given the impediments that have just been recited?
Well, I think that everybody has hit on the single problem, which is lack of investor interest, frankly. And it's because of size, as Todd mentioned. It's because of liquidity. And it's really because of the difficulty in distinguishing what's being offered to them. And so shipping is viewed as much less differentiated than other sectors. Rikard mentioned technology. That's one where you can easily differentiate. So that's perhaps a circuitous way of saying that what really needs to happen is somebody needs to have to come to the market with something which is differentiated. It's not just another fleet of, fill in the blank, that this, that, or the other. There has to be a different strategy. People have to feel as if the things that got them into trouble in this really bad downdraft that we've experienced are not going to recur, and that there's going to be an ability to get in and out of the stock in a meaningful way, or it will come at a severe discount.
Richard, you'd like to respond to that?
Yeah, I think it's important where we have this challenge today, as you all been mentioning, with shares trading at or below net asset value, and it's hard to dilute shareholders on that basis. But I think it's important to create a differentiated vehicle, by being, first, different, unique in some way. We've seen some examples of it. To create a just another tanker company or dry bulk company, the only variable you can compete on is price. And with peers trading below net asset value, that's a hard game. But we've seen some examples, either differentiation in terms of optionality, capital structure, size, sponsor commitment, etc. Recently, we have seen in Norway a few names being established, like Avilco Drilling, which raised capital, marginal capital raise, $65 million for the exposure of 4 times mid-water drilling units at $425 million. So we have the optionality and a strong sponsor commitment. We've seen Dry Bulk 2020 raising the first installments for a series of up to 8 Newcastle Maxes. And they are differentiating themselves through primarily optionality and capital structure and strong sponsor commitment to the other peers today, which are struggling so far, at least, with relatively low pricing to asset market values.
Thank you. Chris, let's follow up on that a little bit and talk about other major markets for shipping, Oslo, London, and so forth. Do you think there are plays to be made there for shipping companies?
I think what my view is, I generally agree with the other panelists. I think equity markets are really challenging. I don't think there's any better market than the U.S. to do a typical public equity offering. I know Norway is very competitive for 144A raises, and you can get onto the main exchange, but all those companies eventually want to come into the U.S. market. I do think it'll change, though, as rates go up and the outlook of shipping gets more favorable. You tend to see the equity markets try to think ahead. So if the overall view of the market is values and rates are going to get a lot better, you're going to see the stocks start trading up on that news, and there probably will be windows of opportunity when these companies trade at valuations where it makes sense to sell equity. I would say, though, the markets that, in my opinion, are pretty good for shipping companies today are, the fixed income market and kind of the preferred market. I think, both of those markets are very accessible at reasonable rates, for quality issuers. The challenge is to use the capital markets for that product. You've got to be quite large. Typically, I'd say, 200 to 300 million market cap minimum, ideally quite a bit larger, and north of 500 million of enterprise value.
Well, let's just touch on that. Do the panelists, do you see an event horizon, a point in the future when you might expect NAV to be closer to the values of the shares? Do we see a timeline? Christa, you would like to touch on that? Do you see a timeline that we might be looking at?
Well, I think it depends by sector, so it's hard to generalize.
Let's do it by sector then.
But it's what I would say is we have tended to see in the markets, right? Price to NAV is just a reflection of what the companies are ultimately earning in the underlying charter environment. NAV is a imperfect measure because it's lagging. Number one, and number two, because everybody on the street has different views. And so, if we go and attempt to calculate a consensus NAV number, inevitably I'll be in a client's office and they'll have a very different view of what their own NAV is, right? So it's an imperfect measure, number one. But I think the question is just relative value, because as earnings recover in a sector, right, over the long term, that also means that asset values should be going up as well. But if there's going to be, some kind of disconnect in terms of the timing of that, sure, in the dry bulk sector, as earnings keep going up over the course of this year, will we see potential for that gap to close? Potentially. I do think one of the hindrances to that gap is, back to the question of company size. But what we have seen is the companies which are larger and more liquid and have a capital structure that is appropriate. There I see most room to break through that kind of premium to NAV level.
Eric, what's your view?
Well, I'd say that I agree with NAV. It's just a very difficult, it's a moving target. It's, its beauty is in the eye of the beholder, if you will. I think that as sectors recover more broadly, as you see, and it takes time because all this stuff that we've talked about the difficulty of getting investors into a sector, but assuming that all takes place, you will see a migration from people thinking about NAV purely to an EBITDA valuation. And as to the extent you can get into that discussion, it becomes a healthier discussion, it becomes a more constructive discussion. And, I think that the NAV issue, the NAV conundrum, is one where ship owners, company CEOs need to believe in the future. And there may be times when they don't particularly like their stock price, but the sectoral opportunity is so great that you take one step back to take two steps forward. And so I think the NAV is just a difficult metric, and hopefully the dialogue can get beyond that and be more forward-looking in terms of opportunity.
I see some heads nodding in agreement. Todd, you were one of them. I know Richard was one. Todd, why don't you start and give us your views, then we'll come to Richard.
I think the key to what Eric was saying is that eventually you have to get investors focused on growth and earnings growth, because that's why they pick stocks, right? They don't pick stocks based on the asset value today, hopefully. They pick stocks on the earnings potential, right? And the growth potential of those stocks. And so why are some of these stocks, serially undervalued or valued at less than NAV, even if it's not a perfect measurement, right? There are other issues. There's, belief that the cycle has shortened, right? So even if dry bulk fundamentals look really good, new orders could come in and erase that in 18 months, right? Two, management and governance, right? So there are, opaque governance structures in some of the public companies, and there's leakage in some of the public companies. And so investors don't care enough to invest in something that has some hair around it. Third is balance sheet, right? Christa mentioned it's got to have an appropriate capital structure, right? I think what investors really want to see is a large company that has an appropriate capital structure, that's paying down its debt, that's amortizing its debt regularly, that doesn't have any exploding maturities on the balance sheet or exploding amortization. And so, again, I think what it comes down to is how do you get investors less focused on net asset value and a discount to net asset value and a more focus on forward earnings, and that's creating an entity that actually has some visibility into earnings growth. And so it's a tricky play. If you're going to play spot market assets, you're destined to be tied to the market. But can you structure an entity with the right governance, the right balance sheet, the right ability to raise capital that, and not have unnatural holders that are looking to sell down, that eventually you create an entity, hopefully, that you can issue equity at times, maybe not have to take a step back, but issue equity at or around asset value to continue the growth model.
Okay. Richard, what's your view?
Well, many of the points were covered here, but I think a net asset value approach is a perfect way to miss investment opportunities. I think you're in a downward market. If you buy at net asset value, first of all, your ships are depreciating by a certain percentage each year, and you have a negative cash flow, so you lose 10-20% a year. I think looking at the next phase when things are recovering here, I think it's all about earnings. So far, we have seen a lot of activity of investors highly familiar with shipping, family offices, high net worth, hedge funds, etc. We've seen recently long funds being more active, but the generalists have not touched shipping yet, and they will start moving when we are looking on when earnings are recovering. If we look at most of the shipping names at today's prices, a 5-year-old Cape, VL, VLGC, Fearmax, and plug in the 20-year average rates, we are seeing cash-on-cash returns of somewhere between 17 to 30%. And in Fearnley, we have $27,000, $28,000 a day on a Cape for 2019, where you have a cash-on-cash return of 23, 24% of a 5-year-old ship. It's impossible not to invest in these sectors when you see that kind of returns. In a good market, the shipping market is pouring cash. So, I think earnings will be the driving factor.
Okay. Let's talk about some of the rise of the stock market. I mean, over the last 8 years, the stock market has consistently risen. There was a 242% increase in the stock market during the Obama years, and recently, I believe, is another percentage increase since Mr. Trump took over. Has that had any effect on the views of people looking into the shipping markets? Because it doesn't seem like the stock prices in that area are rising, whereas they have in other areas, perhaps for no reason whatsoever. But let's talk about it in shipping. Should there be some sort of echo effect into the shipping markets?
I'm happy to start with that. I guess what I would say is, just looking at the price performance of the listed companies, I would say no, the general backdrop has not had an impact on the shipping sector. It's been isolated to the dynamics of each sector. But that said, I think there's an interesting dynamic to think about, which is, the markets have been growing very strong. There were previous presentations that talked about some of the underpinnings of that in terms of corporate earnings growth has really been driving the markets upward. And you hear people start to talk about, is the market as a whole overvalued, right? The PE multiple of the S&P is at higher levels than normal. I think that the general outlook is still strong for the overall markets driven by earnings. But as that eventually softens, which it eventually will, it should be a good time for investors to be putting dollars into more cyclical sectors where they can earn outsized returns. And so that could provide an interesting opportunity to take a look at shipping in that context. Again, it's all going to come down to the individual dynamics, but I think that my view is, to your first question, I don't think shipping has been carried up by it, but I think that it could perhaps present an interesting opportunity as we look forward.
Eric, what's your view on that?
I think that if we look back to when shipping stocks were really strong, I think that in many respects they were a derivative of China's growth and the strength of the energy markets. And I think that we have the potential, assuming we don't have things like trade wars and so on, to re-enter a time when there will be more optimism around those fundamental markets. And what we saw, for example, with tanker stocks was that there were a lot of energy investors who felt as if the pure play into energy was overvalued, and that tankers were a good derivative way to do that. Now, they may not have understood the whole dynamic of vessel supply and demand as well as they might have, but that was the fundamental thesis. I think as a general optimism returns around economic growth globally, that's what drives shipping. And I think that is going to be the sort of thing that, I don't think that the appreciation of the overall market plays into it at all. I think it's really a desire to be at a nexus where there's going to be growth.
Okay. Well, Todd, do you have a view on this? And let's talk about something a little bit different that you touched on there, Eric, tariffs and trade wars. I mean, do you see that as having a depressive effect, particularly, for example, in the dry bulk sector?
Well, look, trade wars are certainly not going to help the shipping industry, right? I think everybody in the shipping space wants open, global, free trade. The question is how, and I'm not a political expert, so I don't know exactly how deep some of these, headlines anyway, are going to actually go on a practical scale. But I think right now the sentiment is that, for the most part, the global economy is growing strong, right? So you have stronger growth in Europe, you have, continued strong growth in Asia, the U.S. continues to grow. So I don't think that has created an overhang on stocks as of yet. And I think really what's buttressing some of the, the undervalue potential here is that the global economy is very strong right now. And so the supply-demand dynamics right now in shipping in almost every sector look good to really good. And so does that translate into stock price performance? I hope so. But I don't, I don't think the negative or the discount to NAV is in any way based on, some of the headlines around trade wars yet anyway.
Good. Let's switch topics a little bit, and I'm going to start with you, Chris, way down there at the end. Let's talk about some consolidations. Obviously, Euronav, Generate, and one or two others that have been burbling out there. What effect, if any, do you see that having on the potential for a capital markets play?
I think we've obviously seen an uptick in M&A activity. If you look at the Generate Euronav transaction, I think it's a particularly interesting example because after that deal was announced, Generate shares traded up roughly 35%. And Euronav shares actually traded up as well, 8%. So, it was kind of a win-win for both companies as far as shareholders were concerned. You don't normally see the acquirer shares trade up, with the acquiree. But there's definitely I think a desire amongst all the investors in the, shipping space to see more consolidation. But I think most of the consolidation we're likely to see, at least for a while, is going to be kind of mergers like the Euronav Generate deal, where it's stock for stock, because a lot of the buyers aren't in a position to pay a lot of cash for substantial acquisition candidates. I'm sure they'll spend cash to do individual vessel acquisitions, but I think today, until you see companies begin to trade, closer and hopefully above their net asset values, you're not going to see very many raising equity for the purpose of making acquisitions. And I think a lot of the sellers, the companies, like the likely, most likely candidates to merge are the sponsor-backed companies, and most of these sponsors, invested, when prices and values were higher than they are today. So most of these sponsors actually don't want to sell for cash. They'd rather sell for shares and get a liquid currency of something they think will trade up, and hopefully give them a better exit in the future. So I guess I'm a big believer in M&A, but I don't think it's going to drive a lot of capital raising, or at least not as much as you would normally expect it to.
Thank you. I would think that you're right about the sponsor-backed vehicles being the targets for these things, because I think everyone knows that one of the exit strategies was, of course, to take those companies public. But if you can't go directly, then maybe a stock-for-stock play is the way to turn that around. Christa, would you agree with what Chris proposed?
Yes, I think that as a general statement, our view is that we will see more consolidation, both due to the sponsor-backed platforms that Chris mentioned, but also I think just regular old-fashioned M&A. We all know what the challenges are in shipping, in terms of ownership structures, et cetera. But our view is that investors are seeking to back companies who are going to find growth through consolidation. And it goes back to the points of equity investors are looking for growth, and you can achieve that growth organically through the charter market. You can achieve it through M&A if you have a transaction that works. You can consolidate commercially in this market as well without M&A, and we've seen that successfully in the tanker sector. But it's interesting that Euronav, which is a company that had done that commercial consolidation through its pooling structure, has also taken this step in terms of actually acquiring another company, and it's a transaction which we think makes a lot of sense for all the shareholders. So our view is, yes, it will continue. Maybe it doesn't drive cash being raised to do the deals today, but I think what it will do is it will set companies up for a healthier way to be issuing capital in the future for their growth needs, whether that's organic or otherwise.
Richard, do you have something to add on that?
I think a differentiating factor is size. Consolidation will be driven by size. We did a research on that through the history on various segments, and it's a company that has a unique position in one segment, either through size or through other attributes, typically achieve a premium to others of 10 to 20% on the equity, where we see some sectors which has 3 or 4 companies in a leading position. There is no real premium to any of the companies because the larger or the faster or best company will be affected by the laggard in the group. But I think consolidation will be a hot topic going forward, and I think the key driver will be size, and through size you have the liquidity and eventually capital of cost of capital. So with real, lower cost of capital than any of the peers will enable you to do transactions nobody else can do. So size is the key driver, I think, here.
Eric, what's the view at Wells Fargo?
Well, I think what's been said is insightful and accurate. I think that the general view is that when you think about shipping M&A, to me, there are very large, well-capitalized private companies that take a very different view from those that are public, private equity backed. I think it's a bit of a tale of two cities there, and I think that there is going to be, among the public and private equity backed companies, I think that there will be consolidation. I think the large, well-funded private companies are going to take a much more circumspect approach.
Eric, how about you? What's Jefferies' position on this?
Todd, but
I'm sorry. So sorry. I'm so sorry.
look, I think
Oh my gosh.
look, consolidation in shipping, right? It doesn't equal market, dominating leader, right? That controls pricing or anything like that. So what is it for? What does it get you? Synergies aren't massive, but there are some synergies. The question is, do they overcome the dyssynergies from some of the social issues that you have to deal with? But look, ultimately, it helps with size, it helps with scale, and it helps with, private equity. At some point, they have to exit, right? And so it's almost like IPO by merger, but they're gonna have to look at it at some point, right? And if we continue to say that, the comps out there are trading at discounts to NAV, if you want to take your company public, it's going to be at a discount to those comps unless you offer something differentiating, then merger has to be an option. The problem is merger with a public company also creates now a public stock that you have to benchmark to, right? So in most cases, these stocks are trading below NAV. You're going to be actually marking down your asset on a daily basis when you have a public floating stock. So there's hurdles to consolidation, but as everyone has already said, it makes sense for the private equity-backed assets that don't have a viable IPO option, are too big to just sell the fleet. And so I think you will see more of it.
Great. We've talked a lot about equity. Let's talk a little bit about debt. Obviously, there's been a fair amount of debt has been issued in Oslo, for example. And what role should debt be playing in the capital markets these days? Richard, why don't you start, since you're the Norwegian representative on our panel today?
Just to back up, we have a trading fleet today of around 90,000 ships, and total world fleet, which is worth around $1,000 billion. If you assume the average age, 7 years, and average duration on the debt is remaining 5 years and 50% loan to value, you have around $100 billion which will need to be refinanced every year. We have an order book of close to $300 billion, assuming 1/3 is paid in there. You have another $200 billion which will need to get financing the next, say 2.5 years. So the next 24 months, we will need to refinance $200 billion and get new financing on $200 billion, so 400 in total. We've heard through the panels earlier today that banks are lowering their exposure in shipping, and I think in that sense, the capital market throughout the capital structure will take a much more active role. The equity is one side of it, the credit market is another. So both unsecured and especially secured debt, we've seen a lot of focus on the last 12 months. We've seen several issues in Norway, which offers a swift and simple process and attracts an international investor base. A few examples with Eagle Bulk, Songa Bulk, we've seen Borealis and a few others. And I think the bond market will be very active the next 2 years, and I think we're going to see new products, both mezzanine hybrid products, convertibles will be active, and not at least say leaseback structures, which we saw on the previous panel. That is capital sources, which we will see a lot of activity with the next 24 months, I think.
Great. Chris, let me ask you this. Can these type of debt instruments compete effectively against the traditional sources, such as bank debt?
And that's I think the biggest point around the capital markets for debt is, your competition is banks and Chinese leasing companies in a lot of cases. And no, you can't really compete against those sources. Those sources are going to be cheaper from a cost of capital perspective than what you can do in the capital markets. But there's lots of situations where, the banks or the leasing companies aren't the best options. We always point to companies with kind of slightly older ships, fleets of, say 5 to 10 years of age on average. If banks need to be fully amortized by 15 years of age, it's, not a good source of capital for them as their break-even rates, become, too high, and the capital markets can bring it down. And then the other area where it makes sense, which, I'd say most shipping companies don't have access to this, but, the better capitalized ones do, is where you do, bank debt, on a secured basis, and then you do unsecured bonds in addition to that. And those unsecured bonds can be a very competitive source of capital for the right companies. But you've got to be, fairly large, and investors have to be confident, even in a downturn, there's going to be enough value left in the fleet to repay the unsecured debt, which is not particularly easy to do if you've got a lot of senior secured debt in your capital structure.
I'm going to get it right this time. Todd, what's your view on that?
Well, it's just on the last point, right? Unsecured debt, can make sense it's more of an alternative to equity, right? So if issuing equity is incredibly expensive because you trade below asset value, again, I think you have to have the right size equity behind you as the debt investor comes in. That's all they're going to be looking for, is how much equity is behind me, and how do I get out in a bad situation, right? So, look, I think the capital markets are open for debt. I think shipping carries less of a stigma than in the equity markets, in the debt markets, but it's still going to be, highly structured. It's going to be, in the U.S. anyway, typically a rated structure, which could have some implications with companies' banks, right? So it's not perfect for every company, but it's something that, large enough companies can have in their tool belt. So they can have Norway, they can have, Chinese leasing, they can have the banks and the U.S. capital markets, and they can, hopefully mix and match all of those options together to create the right capital structure for their company.
Great. We only have about 40 seconds left, so I thought I would just see if the audience had any questions. We have one up here. Just wait for the microphone. It'll come to you in 1 second. Right here.
Yeah, I heard a lot of conversation about liquidity. How do you feel about consolidation across sectors to create market liquidity? In other words, where we have dry bulk and other sectors coming together with the result being size, but not necessarily market clout in a sector.
Anyone? Yeah. Okay.
Yeah, that's a good question. I think it's a balancing act, right? Because there is this view that people like a pure play. What we've seen is that people really like liquid stocks, and I think if there's some experience behind it, I think if there's a logic to it, I think that the liquidity of the stock will trump that concern about a mixed fleet.
Any other questions? And I think we are done. Thank you very much, panel.